Hey everybody,
Recording in progress.
welcome to the show. Welcome to the show. Jack, you here with us? Let's see. Can't start without him. Sorry,
Oh, no.
inaugural show. There he is. There's the
Yeah.
man.
Yeah. Hey, how are you doing, Jeffrey?
I'm doing good. I'm just shoving some corn dogs in my face here before we get started.
Corn dogs. Let me
Yeah.
see that thing.
Well, I mean, right now they're just two sticks.
Oh, wow.
Sitting here, sitting there cramming in my face right before we went live.
Well,
Welcome everybody. This is the inaugural show of the Market Masters. Jack and I thought, if we teamed up, we could probably provide income traders a little better content. And for lack of a better word, we think we can help more people if we teamed up together.
yeah,
So
no doubt about it. So, everybody in attendance, thank you for being on here today for our first show. And be sure to tell your friends about this. We're going to do it on Wednesday and Friday at 11:30 every week. It's going to be great. Uh, Try to outdo every other show you've ever been on and help you guys just straight up make money. That's what this is about.
yeah, and since we're going to talk about trades and stuff like that, all trading involves a substantial risk of loss. Of course, we all know that past performance not necessarily indicative of future results. Just because things have worked in the past, things could change in the future. And this presentation is intended to be informational, educational, fun, hopefully entertaining. Not a recommendation to be doing any trades out there, buying any financial instruments. And if you desire personal financial advice, well, Jack and I are not going to give you that to you. So you got to go hire somebody to do that for you. So welcome to the show. All right, Jack. This is our first show. So everybody here is new because this is the first show. I want to welcome everybody. Thanks for coming here, being with us, hanging out. Hopefully, we're going to get you some valuable information, and we're going to talk about income trades.
Yeah, and a lot more. All kind of
Yeah,
technical things you're going to learn. All kind of Jeffrey's retracements. Hello, Ellen and Craig and Earl Robinson. Good to
yeah.
see you guys here.
I love to see the crowd. Looks like a pretty good room, Jack. So
Yeah.
we kind of thought we'd. I thought I'd start it off with a pick. I don't know, Jack, if you have a pick of the week. I have a pick that I like this week, and I'm just gonna pull it up here really quickly. I know it doesn't quite meet the criteria you were talking about up in an uptrend, but it is potentially bottoming out here. We'll look at it. I think this could be the next like Abercrombie and Fitch run. And it's Gap. We've all heard of Gap. Gap closed, Gap in the mall, Gap, they run Banana Republic too. And I think this thing is maybe done consolidating right here at the bottom and about to take a Abercrombie and Fitch style run higher. I'm actually selling some puts on it this week at 19 strike, and we're at 21 right now. So
Nice.
this one might go out for money. So
Can
this is
you,
my pick of the week right here.
can you show me a 6-month chart of this thing with the daily bars?
Yeah, this right here would be the 6 month, right? They're
Ooh,
starting at
wow.
2025. We got a nice little pop and then a retrace. So
Is that gap down from 28 to
it came from 28 all the way down to 22. We're sitting at 21 right now, coming back up.
was that gap on down on earnings?
It was.
Now, personally, I believe that all gaps have to be filled in somewhere down the line.
Yeah.
So from this standpoint, this thing is going to fill in that gap. That alone
And,
would be a compelling reason for me.
and the beta on this is 1.2.
Like that.
So
What's beta? All right, folks. Beta is a measurement of volatility. The broad market SPY is a beta of 1. Anything with a beta over 1 is more volatile than the broad market, which is great if you want to trade options. You pretty much want that beta over 1. So far, this thing looks great as a trade
yeah,
of the. How far out are you going to go on this?
I actually played this week. Now we do have earnings coming up right here on the 28th. So I played out this week. I plan on playing it again maybe next week if we keep this uptrend intact. Of course, my personal system, my roadmap line resistance coming up right here, just above us. Once we clear that, as Jack says, things get likely to go at least fill the gap.
Fill the gap. Now, are you doing a naked put here?
I did at 19
No,
strike. I did that on Monday.
if you think it's going higher, would you go long the stock in addition to the naked put?
Now, I like to get paid to wait and paid to get a good deal.
Amen.
A lot of these stocks will do dips and accidentally put you in the stock on Friday, and then you come in Monday, and guess what? It's well on the way higher.
I like it. I like that.
So I like to go aggressive, and 19 was right there at the bottom. So
What's that pay?
it paid. Let me let me pull that up, and I'll show you what I actually did.
That's a nice trade there.
Just give me 1 second. We'll pull it up, and I'll show you the real deal order right here. Right here. Out of my Robinhood account, I did 12 put contracts on Gap for the 19 strike. Got paid $15 a contract.
Whoa. 15?
Yeah, that was 15 actual bucks, so 15 cents, but 15 actual bucks. So per
Okay.
contract, 12 contracts. I mean, that 15 cents for 4 days of risk. that's a that was a healthy one at $19 strike. So
That's good. And you figured out the yield on that too, right? On cash or on margin.
yeah, so let's just go through it here. So I did, I get paid $15 times 12 of these. It's 180 bucks in my account right there. As Jack says, deposit immediately. And for me, they're tying up all the money it would take to buy 1,200 shares at 19. That's 22,800. So 180 bucks divided by 22,800. And, Jack, as you know, you can get a much better deal if you go margin and stuff like that.
But cash
That
security is awesome.
that's 0.789% for 4 days.
I
Yeah, I did
love it.
this yesterday. Or I did this Monday. So we're talking Tuesday, Wednesday, Thursday, Friday, 4 days.
I gotta tell
What?
the folks too. Go ahead, Jeffrey. Didn't mean to
No,
interrupt.
I was gonna divide this by the 4 days.
Yeah,
Return per day, 0.19%, almost 0.2%. And we
better than
multiply
a
that,
credit card company.
then you multiply that by 365. We're talking about 72% return annualized right there for that
Yeah.
trade.
Better than a credit card company. Higher yields than if you were issuing your own credit card.
Now
Yeah,
think about it. If you could do this trade every single day and hold it open the whole year, you would make 72% return.
I love it. Now, you said that payment when you sell that naked put, that hits your account instantly and automatically, and that payment is guaranteed by the CBOE. But one thing I find interesting on these naked puts, and a lot of strategies even, but especially the naked put, is that you would think you would only get paid at expiration if you were right. But it's crazy with naked puts. You get that money up front. I still can't get over that, and that's really what attracted me to income style trading is that you get to hold on to that money up front and first. You get paid to take the trade rather than you paying to do a trade. I love to get paid to do a trade. And this is a classic example of that.
Now, Jack, since this is a new show, we might have some people among us that are not exactly sure what we're even talking about right here with calls and puts and doing that sort of thing. So I thought maybe we ought to just talk through options trading just a little bit and maybe we can take it a little more advanced on Friday and just talk through what it is we're doing on this trade right here.
Yeah, that's good. We don't want to be above anybody's head. I've been on some of these shows when you get these guys that they're just talking to tell you how much they know. They really aren't explaining anything. And we're not going to do that to you guys. So anytime you got a question, pop it in the chat. This is live. We're here for you, not for us. So let's get into the basics of this.
Yeah, so you have stock. Hopefully everybody understands stock. It's shares of a company. And, Jack and I are looking at kind of trading the stock, but we're doing it with contracts. And contracts are promises and obligations to do things in the market. And if you buy a call, you're taking on the ability, it's not necessarily the requirement to do anything, but you're taking on the ability to buy stock at that strike price, as they call it, at some point in the future. And usually we call that the expiration date of the contract. Now, for US style options, which is most of the options that you might trade out there, you can execute that option anytime up until expiration day. Now, say you want to take on, you think your stock might be going up, right? And you want to take on the risk, but you don't want to, you're just not sure enough to buy actual shares. So you can buy a call. Let's say you're like, hey, Gap, I want to play this gap fill. I could potentially buy a call. Maybe, all the strikes, they're kind of in dollar increments here. We can actually pull up an option chain on TradingView now. If I find there we go. There's the button for it. We've got all these expiration days. These are the contract expirations. Jack likes to play about a month out. So let's say you thought that Gap was going to go up there and fill the gap on Gap, and you wanted to buy a call. You could buy in what they call in the money, which is a call that's strike price is less than the current trading price, which is at $20.94, or you could buy a contract that's out of the money, which would be anything above the current price for a call. And it costs you money. So if you bought a 21 strike, slightly out of the money call, expecting Gap to go up and fill that gap at 28, it's going to cost you to go out to September 19th. It's going to cost you about $1.60. That's a direct cost. That money comes out of your account.
160 per contract. Yep.
And if Gap does nothing between now and expiration day, you lose $160 per contract. Contracts are increments of 100 shares when we're talking about regular US style options. So this $1.60 right here becomes times 100 shares. They price it in per share prices for whatever reason. That becomes $160. So at a minimum, you need Gap to go up $1.60 just to cover what you spent right there. But if it goes up to 28, well, your 21 strike goes $7 in the money. That's pretty good. It's pretty good. So that means your option becomes worth $7 at a minimum if it goes all the way up to 28 by that expiration day of September 19th. I mean,
that's exactly why people buy calls, is they want to buy one for $160 and watch it go to $700. That's the hook. Nothing else is going to give you as big a bang for your buck as buying a call, but it also has one of the lowest probabilities. But that's why you just showed an easy way to make 600%, right? If it works.
Yeah, if it were. That's a big if, So we're looking at, just break back out the calculator. Potential $7 profit with our $1.60 cost. Yeah, really, it's 437% potential return right there in a month. I mean, It's hard to find much better bang for your buck out there in the market right now.
Wow.
That's a big potential return. But Gap has to fill the gap to get that return. And the odds of that happening in the time frame that you guessed, I mean, you got to be right on direction, you got to be right on time, and you got to be right on the size of the move. That's a lot of things to get exactly right. So that's one way you could play. And that's how you could play calls. Now, you could go buy shares. If you bought shares right now, sitting right at $20.96, that's going to cost you how much? $2,096. What's your risk? $2,096. What's your potential reward? Going to 28, that'd be about a $700 upside. So that risk to reward, this is why people love trading calls. And if you've always wondered like how and why people love this, so we're talking about a $704 potential upside roughly with a $20.96 cost. That's 33%
in a month.
And assuming you got there in the same time frame, but you're not limited to the month when you buy shares. shares don't run out of time. We could actually keep holding these and wait for that upside target. So that takes the time frame off, but you still got to be right on direction. And that's good, 33%. But you might be sitting there going, well, you guys were talking about 72% annualized return. And that, this rate of return annualized depends on how fast it gets there. If it got there next week, that'd be a smoking hot rate of return annualized. But you'd have to do it again. You'd have to find another one. If it took longer, maybe it took a whole year, that'd be a 33% annualized rate of return. So that's one way to calculate this risk. Now, there's another whole other side of the options chain called puts. Now, if you were to buy a put, you're getting something for your put when you buy it. When you buy that put, you have the promise of somebody else to buy those shares from you at a price
Think
that
about
we
it.
call the stop price.
You buy a put, you own the right to put the stock to somebody at the strike.
Yeah, to give it to somebody else, sell it to somebody else at that
Right.
strike price.
When you buy an option, you buy the right. When you sell an obligation, when you sell an option, you sell the obligation to deliver.
Yeah. And so maybe you wanted to buy the shares, but you also wanted to protect it from dropping below 20. So you could buy those shares, protect it from dropping below 20. If you're trying to reduce your risk more in line with doing the call. So you spend $2,095 right now to buy the shares, and then you spend another $110 to buy a put at 20. So now your cost just went up to $2,200, essentially. Just went up to 20.
You have stock, and you have the right to put it to somebody at the strike price. So if gap goes down, the value of that put is going to go up tremendously.
So we're looking at a cost of $20.95 for the shares, and then about $110 to buy the put. Now your risk is only what you spent, which is going to be $2,200, pretty close. Just round up down to 20, which is 2,000, which is what you could put that stock to somebody else. So now you have a $200 risk in this, and an unlimited potential upside. Very similar to the call, except you're not limited on time, except the time that your protection runs out down here. So this is another way to do things and still get upside gain.
You're buying insurance here. You're buying
this would be buying insurance. Now, at the same time, you could also sell a call, which gives you, as Jack said, the obligation to deliver those shares
the strike
at the strike price. Now, you could sell a call up here if you thought it was going to 28, and you could sell it. And it's not super lot of premium at the moment right now. Maybe you want to wait and sell that call when we get a little closer to 28. But right now, if you sold that right now, you probably get about 12 cents, $12. It's not big money. You get $12 to sell that obligation. But that could take a little bit of money off that $200 risk that you've got there today to get in that trade. And this is it's called a covered call with a married put. All right, that's downside protection, and you kind of cap the upside to 28. You're not going to make any more than 28. Well, you might make a smidge more, but not really much more. Ballpark, you're going to be limited to 28, but you're going to be protected at 20 in doing this. So this is interesting, right? We're getting interesting.
Very tight. You got this whole thing boxed up, right?
It's real boxed up, and I like to breathe. I don't know about you, Jack. I like to breathe in a trade. Now, we talked about selling the call and giving us an obligation. Now, what happens when we sell a put, Jack?
We've taken on the obligation to buy the stock at the strike, but we get paid for making a promise. And what I love about naked puts is you get to decide how much you want to get. You get to decide the strike, right? If you're going to get paid to make a promise, that's like the best strategy in the world. You don't even have to buy it. You're getting paid just to say that if the stock goes to X price, you would buy it. And you're getting paid up front to take on that obligation. That's good business.
Yeah. And, just for example, we can go down to 19. And I was talking about this in the opening here. You could go down to 19 out roughly a month and get paid 70, 71 bucks right there to take the obligation to buy Gap at 19. That's not bad. Now, the return was much higher here at only 4 days out. That's why I played 4 days out, not played a month out right here. So this, we're going to explain more and more about this. Make sure that you come and hang out with us every time we do one of these shows. We're going to get more and more into all the details of this, how it works. I know we're kind of like, we've been doing this a long time, and your questions in the chat are what's going to help us fill in your knowledge gaps.
Yeah, let's answer some of these questions. So Robinson says, for selling a put, you cover with cash, correct? You could do it on a cash basis, Robinson. That's where you would have the cash in your account to buy the stock. And then you could do it on margin, where you would only need 20% of the underlying stock basically to do it. So either way is good. You can do a cash secured naked put. It's still naked. If you sell it, the only way to have a covered put would be if you were short the stock and sold the put. But this is a naked put, and that's fine. If you want to buy the stock, you get to pick the strike and you get paid for making the promise, but that's still a naked put. Liberty says, sorry, there's not 365 days in a year, approximately 250 with holidays and no days off. However, Liberty, in this business, we always calculated by 365 days in the year, not 250. That's business days.
250 trading days, but there's actually 365 days in a year. If you, yeah,
That's
I
how
don't know
you,
about you. If you go out, excuse me, if you go out to September right here, you're trying to calculate the annualized rate of return. Like you're going to tie up you don't just tie it up during the weekdays. You tie it up on the weekends too.
all tied up. Now,
So
Chris says, what is a naked versus just a put? Thinking the stock is going lower, or is it the same thing? Where a naked put, Chris, is when you sell it, and a regular put you might think of as something you buy. So two different sides. Naked put, you're getting paid. If you buy a put, you're paying.
so there's another aspect to this. How would you have a covered put, Jack?
You'd be short the stock.
Right. So this is everybody's heard of a lot of people have heard of covered calls. Most people, you may have heard it, you may not have known what it meant. We were talking about doing that when we were talking about selling a call and owning the shares. So when they refer to a naked put, that means you don't have any share exposure. You're just using cash in your account to cover that, cash or margin to cover that short put position. But you can be short puts or short shares and then short puts at the same time. And that's a covered put position right there. So that's not necessarily a big money making way to do things, but it is a covered put position. So it's hard, as Jeremy says, it's hard to comprehend how they pay you or why they pay you. So you're taking on an obligation to buy shares. Somebody out here is buying these puts. Somebody out here is buying these puts because they think Gap is going in the toilet.
Now, let's say, let me back up. Let's back up and just tell them options are a zero sum game. That means it's just options are contracts, but just between two people. There's a buyer and a seller. The buyer buys the rights, the seller gets paid to take on the obligation. So when you're selling a naked put, you're selling it to somebody instantly. Why they're buying it is for their own reasons. But when they buy it, they're paying you. That's what I love about it.
And also, they can turn around and sell it to somebody else when they buy it.
Because
So
most options aren't exercised. Most of them are just sold, turned over.
yeah. So Jack was a market maker, so he speaks from a level of experience that I can't even comprehend at this point. That's one reason we teamed up. He's got a lot of knowledge, and I've got a lot of theories.
You've
So
got a lot of
between
knowledge, brother. I don't sell yourself short. You're the most brilliant trader I know of, especially not having worked on Wall Street, and you've cracked the code so many times. It's just unbelievable.
so as we work together, we're going to fill in my knowledge gaps. I'm going to try to fill in some of Jack's you know, maybe he doesn't care knowledge gaps. He's been doing this a long time and making a lot of money, and but we're going to try to make everybody better by working together.
Now, Chris
And
has a good question though here. I don't mean to interrupt you here, but Chris says,
yeah,
what if the stock goes past your strike? You can let it go to increase profits? No, you're capped. If you sell a strike price, let's say at 22 strike price call, covered call here, and the stock goes to 28, the most you're going to get is 22. You're giving up more upside.
now that also works on the downside. Like when we sell this 19 and it drops down to 18, when we buy that stock at 19, we're immediately underwater $100. So that is risk that is inherent to this, what we're talking about right there.
Yeah. Jeremy says, do you both typically use this method? Yes.
Yeah. And in fact, right here, I have a publicly available tracker right here on KInfo. I started this account, I funded it on April 16th, I think it was, and I'm up $23,000 or almost $24,000 in this account with publicly closed trades right here.
You're killing me.
Doing
95% win rate. Look at that.
doing this method right here that we're talking about. This
Yeah.
is one reason that Jack and I teamed up together. I've been doing this. I shared this with you.
Yeah.
My goal in this account right here is to build it up to a point where I make $50,000 a month reliably doing this method.
Wow. I love that. This is a great way to make money. And you look at, most traders, they probably have about a 10% win rate, if that, a 95% win rate. That just goes to show you, you looked at what he's doing. That's not a lot of risk, right? He's got it boxed up pretty tight. And you're winning 95% of the time. So what that's going to do is make you a lot of money, but it's also going to build your confidence. And that's one thing I see, just a tremendous lack of confidence in people. And that's one thing we want to also get you over the hump of, build some confidence, put together some win streak. And this is your guy right here. Now, that challenge for 50 grand a month, are you making that public? Can
Yeah,
people?
this is I don't share the trades as they happen publicly. I share that with my VIP group because it's a lot of information. It's a lot of there's a lot of moving parts that go into this. But I do share all the public trades as they're closed right there on KInfo. You can see every trade as it's closed. And let's talk about how do you make a big bunch of money? We see one big candle of profit in there. What was that? Let's break down this trade, shall we, Jack? What do you think?
Yeah, do it. Break it down. Break it down.
All right. So, like I said, all the trades are available here for everybody to see. I don't hide them. You just pop onto my KInfo. You can go to kinfo.com, search for me, Jeffrey, just under my name right there. And you can actually find me on the leaderboard, on the 3-month leaderboard. I don't have enough trades for the 1-year leaderboard yet. But scrolling down here, we find the big trade. 10,000 bucks right there with another 700 right there. Now, I sold puts on Rocket Lab, RKLB, for a couple weeks and got paid handsomely. And then all of a sudden it dipped on a Friday and I got put those shares. But then it turned around, and we'll look at the stock chart here in just a second. Then it turned around and went on a heck of a run. And I sold upside calls like a madman. You can see I got paid 700 bucks on that last one when they called out the shares. So I got paid on the shares and the calls, and
You
I
got
lost the shares.
So you got assigned on the put and you got assigned on the call?
Yep.
Very nice. Now that's a lot of people I talk to. I love naked puts, and people are just afraid of having the stock assigned to them. But I see so many instances where that's not even really a downside factor. Here's one of them, and again, I'll tell you, naked puts, the best way to do it is when you got a stock that's in an uptrend. That way, even if you get it assigned to you or put to you in a little blip down, you still have that underlying trend for support, and that's where you see this turnaround. So it should be a naked put should be on a stock you want to own for whatever reason, for a trade or whatever reason. But look at that trend, that uptrend. That's great protection. So most of the time, unless you're close to the market price of the stock in an uptrend, you won't get it assigned to you. But if you play it a little closer to the market price, you got a better chance of getting it. Like in this one, I'd say that they gifted it to you, right?
Yeah.
Did.
So I got put the shares at back here on June 13th at $26, 26 strike.
It's
I
crazy.
got called out June 18th
5 days later.
at 41. This is that was actually almost a month. Like that was almost a month, June to July,
Oh, okay.
just a little over a month. But it
Awesome.
went from $26 to $41, and it actually went over 41, and I got called out
And you got paid twice. Got
three
paid.
times, really, because
You got paid when you sell the naked put. And whatever premium you get on that, if you get the stock assigned to you at whatever price, you subtract the amount that you receive for selling the naked put, and that's your cost basis on the stock. So it's always going to be lower than the assigned price at the strike because you got paid to sell that naked put. But this is awesome. This is just absolutely awesome. You never bought the stock, you had it assigned to you. And like I say, the best part of it is you got paid 2 times. You got paid when
three.
you
I look at it as 3 times, Jack. I got paid once for selling the put. I got
Right.
paid once for selling the shares, and I got once for agreeing to sell the shares at that
Yeah.
41 strike.
3 times. Woo! That's the stuff I love right there, people. That's good stuff right there. It doesn't get any better than this, as far as I'm concerned. To make money, getting paid at two income trades, and then a capital gain on the stock. That's where it's at, my friend.
And let's just dive in here and actually take a look at what happened on this. Um, I need to turn off that and turn off this. So here's the chart. Let's draw a couple lines so we know where we're talking about. June 13th is where I got put the stock. July 18th is where I got called out, which was right there.
Wow.
Maybe like, well, you got lucky, right? This has a lot. There's a lot more to this than just getting lucky. So my signature breakout pattern, pullback breakout pattern, I actually started selling puts on this right here back in May. I sold puts on this every week until they gifted me those shares. It just dipped that one Friday enough to get assigned shares. And then Rocket Lab went on a rocket ship.
Now,
I sold multiple calls all the way up through here. The last one was at 41. And look, the price today still at 43. It's not like it's gone anywhere since I got out. I haven't gotten back in because it hasn't done another pullback for more continuation. So I combine, this is commonly called the wheel strategy. And I combine my trend pullback continuation pattern with it. And I've named it the turbo wheel because you can turbo some gains when you catch one of these moves right here. This was the first one I caught, and I'm going to have more because I keep doing the same thing.
Yeah, get 4 to 5 times, get paid. Incredible. Yeah, I did this, Joseph Simon. I did this on Archer Daniels Midland 5 times before I got it assigned to me or put to me. And I was trying to get the stock the whole time because I already had a position in it and I wanted a little bit more. And that's the most boring stock in the world. I wouldn't even pull it up, but it's just goes to show you that you can do this 4, 5, 6 times and not get assigned and then get assigned. And you got a big stack of premium that's going to lower that cost basis from the strike that you got put to shares. So it's hard to lose with this. That's the other thing. You got a 95% win rate and you're doing it on the right stocks at the right time. And this wheel strategy is just the money makingest thing I've seen.
Now, see, here's some examples. I sold them starting back in May, sold put options, And we kept doing it all the way up through here. Sold put options, more put options. Sold another one right there. Just kept doing it until I got put those shares. There's going to be the one I got put. There's going to be the one I got assigned right there. I got paid $200 on that
It's
position.
an obligation, right? How do you
Yep.
like that from a business standpoint, folks? Getting paid to make a promise. Doesn't that sound like a good business to be in? I think so. You don't have to do anything. You're just making a promise and you get to pick the strike. You get to pick the time. You get to pick the stock, the expiration. You're in control of the whole trade. And you're getting paid 17 ways from Sunday.
And when you chase after these ones with a higher beta, this one a beta of 2.47, Jack.
Whew, I like that.
So this one, now it needs, right now, would I sell puts on it right now? No. I'm waiting for this to pull back to support once again. Once it proves we've got a support level, then I may go after it again. Right now, it definitely got a little lofty, especially when you look at the fundamentals of the company. Bad, we got red earnings all the way across here, and they don't really make any money.
Now,
So
so do a lot of people are afraid of doing a trade during earnings week or earnings season. What's your thinking on, would you back out of a trade because there's earnings coming up?
now there's a couple. I'm not gonna just gonna close one of these because earnings is coming up. I'm into these because I believe they're bullish. I was trading this like crazy back here because I believed it was bullish. Now, would I go after this one? Was I going after this one into earnings right now? No, that popped out at an expected resistance level and started pulling back as I expected. That's starting a downtrend. This downtrend can continue until it finds a support level, potentially where these things meet up right here between my signature roadmap line and this breakout level. That'd be a beautiful place to go back test. If it comes down to there, holds, I'll probably sell more put options against it and try to catch the next move.
Love it.
But right now, it's on my pause. Don't chase things ridiculously higher into ridiculous, extensions when it's probably due for a pullback. That's just my basic rule I've come up with over a lot of years of doing this.
So Ruth says, how do you decide to sell a call or sell a put? Well, when you're doing the wheel, Ruth, the first trade is a naked put.
You always start with a put, and you always go at a price that you want to buy it. You have to want to own the stock. Rule number one, you got to find a stock that you want to own. And you can't waver on this. It's not like, well, it might be good to own it. I wanted to own Rocket Lab because I believed it was going up to at least 41. Why 41? That was my fib line target right there. That's why I sold the 41 call. That was my pretty optimistic target. But even though we went a little higher, I don't really care. 41 was that's 70% of the time. Once we cross this right here, we're likely to go to this right here. 70% of the time, this was a pattern, high probability pattern I was trading. Now, I went after this, and I went after it, and went after it for a whole month before I got put those shares, and then wrote it up. I wanted to own it. All right, I didn't change my mind just because it was a pullback right here. So that's the number one rule for me: is you have to want to own the shares.
Me too.
If you're unsure, you're just like, well, it seems like it might be a good opportunity, but don't trade that stock. Period. End of story.
It's got to be one you want to own. And for me, it's got to be in a trend. I would never do this on a stock that's trending down because you're just going to get your face ripped off.
Yeah, I mean that's entirely true. And Jack and I have been on Profit Panel the past several weeks, and we would bring up stocks, and it's when you have lower highs, lower high, lower high, lower high on a chart, especially when you look at a 6-month or even a year-long trend that's down, 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 down. Don't catch a knife. Trying to buy the bottom, pick a bottom is called catching a knife. The knife can cut an arm off or cut the bottom out of your account and watch all the money fall out. You got to be really careful grabbing stocks in a downtrend. Jack prefers to grab stuff in a proven uptrend, and this kind of meets that criteria a little bit, especially if we go out Jack, I've been talking about that pattern where things make a 52-week high
Yeah.
after consolidating for a little bit.
Let's run that
Check
whole thing by him real quick.
check this thing out. I did that three to 6 month consolidation here and went on for new all-time highs.
So the pattern is walk us.
So so the pattern is a stock has been moving up. All right. Now, it's not particularly interesting when it's just moving up. But we need that as the first piece. Stock has to be moving up. Now, we need it to go into some sort of consolidation. 3 to 6 months is the golden time frame for this. Once it breaks out of the consolidation and makes a new 52-week high, which is the highest high in the last 12 months, that's a breakout. Now, stocks that have shown this pattern have shown the potential to outperform the S&P 500 by 30% on average across, hundreds of these stocks over the next 6 to 12 months. The trend, this breakout could last only 6 months, could last 1 month, but it could last 6 months, could last 12 months. So 6 to 12 months usually outperform the S&P by 30%. That's a pretty good pattern to follow if you're going to be bullish on something.
Yes, it is. Now the new high for me, that's where it all starts, right?
Well, that's the indicator. Like, you don't know it's a 52-week high to check for this breakout pattern. You got to watch a 52-week high. And there's a great place to go grab a list of these every single day for free. I call it, it's the website's Market Chameleon right here. And you click on Market Chameleon, you go to the stocks tab, you come down here, 52-week highs and lows. You click the button for 52-week highs. It's going to show off all my personal information. And then you can sort by volume and pull up higher volume. I like to trade things over 1 million. Jack, how about you?
Yeah, million minimum.
Million shares moving in a day, that means it's fairly liquid. All right. If you're going to get put the shares, you can get back out of the shares pretty easily. That usually means the options have some liquidity too. Not always. Now, I like to look at stocks with weekly options too. So that adds an extra layer of complication to it. But there's a whole list of stuff making 52-week highs today.
Yeah.
In
No,
fact,
that's
there's 642 of them.
that just goes you, and then you got 102 new lows. That just shows you right there how strong the market is. But for me, this list is too big. I use the trend point software, and what that does is it takes stocks that have hit a new 52-week high. But as you see, how are you going to sort through 642? Well, what I do on top of that is stock has to be over $25. That's going to eliminate a ton of them right there. Stock has to trade 1 million shares. That's going to eliminate a bunch of them. Stock has to trade on a major exchange, New York Stock Exchange, NASDAQ, American. That's going to eliminate some of them. So when you do, and then what you want to do is once you got that short list of stocks, then you got to go back and see, did this make a new 52-week high because it gapped up on news? Or did it make a new 52-week high because for the last 3 to 6 months, it's been chugging higher, right? You want to have that 52-week high, but you also want to couple that with a trend, right? Stock over 25 million shares a day, major exchange, a new high within the context of an uptrend. Yeah, take a look at IBIT.
IBIT, it's been a favorite of mine and Jack's. So let's go look at the chart here. IBIT's right up there near the top.
Now,
Look at that pattern.
I
Look at that
just
pattern.
I just sold the 65 strike price naked put.
I actually got put shares about a week ago. It's right here on Canfo. We could see it right here on the 2nd. I got put shares. I actually got put one. 3 of them went out for no, it's kind of funny. I sold 4, got put 1, had to buy 100 shares. The other 3 went out for 0. So I got paid 60 bucks per contract to take on the obligation to buy this at 64.50.
What was your strike?
64.50.
Oh, okay. Yeah, you just said that. Okay,
Yeah.
great.
64.50 right here. 64.5 right there.
Something that's also interesting, folks, about this is that I've sold this 65 naked put couple times, and the stock has gone below 65, and I still haven't been put to stock. So sometimes even if you're, look at that. Yeah, I never got it put to me. I don't know why. Probably it wasn't going a lot lower, but you don't have to freak out if you have a naked put at a strike and the stock goes below that. It doesn't mean you're going to get the stock put to you, right? It could happen at expiration. It could not happen at all. But yeah, I'd love to own it at 65. I have a ton of it. I'm already doing the wheel on it. I love IBIT for a lot of reasons. The trend is great. What's the beta on that is wrong. It's
Yeah,
not right.
I
It's
don't
got
know. I
probably
didn't calculate it.
two or more beta. So, and the other thing is this stock relative to the market, it's affordable, right? So $6,900 would get you 100 shares. And then from there, you can sell covered calls, which I've been doing that. That's amazing. Or you could start the wheel strategy today, right now, selling a naked put anywhere you want. You can
I
also get this from barchart.com.
This was just a free way to get the information. I like free stuff. Jack says, he's taking a lot of the extra work out of it. If you're somebody that, maybe you're just getting started, you don't got a lot of extra, ability. This is a free way to get the list. Yeah, you've got to work for it. You got to start diving in here, looking for the pattern. And, but this is for free. This is for available for anybody. Just go to marketchameleon.com, pull it up and click the buttons.
And
And it's
you don't have to make it hard. Once I go back to the well, as long as the trend is continuing, I won't go through 600 stocks. I'll just pick 3 to 5 and go back to the well on that stock over and over and over and over. AVGO is one I've been doing credit spreads on that. I don't even know, years. Whether it's a bear call or a bull put, that's been a great stock to do credit spreads with. But
people
IBI
want to
is
people want to know where to find the beta, Jack. So I use TradingView because it's free for everybody to use. Yet again, like I like to do stuff free. I don't know. I mean, so TradingView is free. You can just go make an account. You don't need to buy data. You don't need to buy a subscription. You don't like to get started. You can just go there for free. You pull up IBIT. You go to, well, you have to go to Super Charts is what this is called. You click on to get to this after you made your account. Just make a free account. Don't got to pay. Just tell them you want it free. Try it out. Then click on Super Charts, type in IBIT or whatever stock you want to. Pulls up this little panel over here on your bottom of your watch list. If you don't have it, you got to click a couple of the buttons and this panel should be down there. Click that little expansion button for more information. All the normal stats for anything are listed right here. Now, ones that have dividend will have the dividend yield filled in, beta, total holdings, all the different stuff. The holdings for this is just one. It just holds Bitcoin. Does it pay a dividend? No, it just holds Bitcoin. They don't do anything extra, no fancy stuff, no treasuries, no nothing to generate any extra money. Just holds Bitcoin. So there's cost to this one. And those costs are actually shared with you on down the list here a little bit, the expense ratio. So some of these ETFs will have management fees, and this one loses 0.25% per year if you just hold it. And they take that out every day when they rebalance.
I'm
They take a
seeing
look.
I'm seeing a 60-month beta of 2.51 on
There you
Bart.
go.
I think that's more accurate.
Yeah, I don't.
Bart is free also.
I don't run. I don't run TradingView, but there you go.
Yeah. Yeah.
So if you're going to hold IBIT over just going to buy Bitcoin, the way you make money holding that is to sell some upside calls and downside puts, and that's how you make IBIT pay you for holding a Bitcoin.
Right. Now, I got to say, a lot of billionaires moved out of the actual Bitcoin. They sold that on whatever crypto platform, and they moved the money into IBIT because IBIT is a spot ETF. There's no leverage. It just moves pretty much tick for tick with Bitcoin. But the difference is you can't create cash flow on Bitcoin, but you can on Bitcoin in the form of IBIT. So this is like a Bitcoin proxy. You don't really own Bitcoin. The trust does own the Bitcoin. So that's how it moves. When you buy this IBIT, the fund buys Bitcoin, so it's spot on. But like I say, you cannot cash flow Bitcoin itself, but when you turn it into IBIT, which is the same as Bitcoin, now you got unlimited cash flow opportunities. And if you believe in Bitcoin, I think it's going higher. Uh, this is a great, affordable way to get in and create cash flow.
Yeah, and the premiums available to create that cash flow are pretty rich in here. I have, I got put those shares at 64.50, but I got paid to do that. So my cost is actually down
Get
at
that.
63.90 right now for those shares. So my cost is 63.90, and I sold the 69s for this Friday. And I might get called out on Friday, but I don't really care because I just made 65, 66, 67, 68, 69. I made $5 per share plus what I got paid to sell that obligation.
And you know, folks, the best part about trading is taking a profit. And here you're taking one when you sell it, the naked put, you're taking another one when you sell a call. And if you get called out, you're getting paid three ways.
It's beautiful, Jack.
It is beautiful. It's the most beautiful way to trade stocks. You know, most people they want to find a stock that's going to go up, and that's Wall Street's job is have an analyst pitching you on what stocks they think are going up. But there's so many better ways to skin the cat than just trying to find a stock that's going to go up, right? I've
Yeah.
sold on Apple. We did the covered call strategy with Apple, and we made a ton of money, and Apple just went sideways that people are saying, like I showed them the P&L, how can you make all this money over 6 months when the stock goes sideways? Because the stock didn't go up, and you'd think you'd only make money if the stock went up. But here, if you're just doing covered calls alone on the stock, uh, you're bringing in money like crazy every month, even when it doesn't go up. You could be up 50% for the year, and the stock only went up 5% because you were selling covered calls every month.
And Apple's beta is above 1, so it has more volatility than the S&P.
Yeah, yeah, great example.
And Jack, I think we should probably talk about our favorite stock right now. I think maybe it's both of our favorite right now.
Yeah,
Did
what I love about this is the opportunities that you get in this stock with options. What's interesting about Tesla, everybody, is sometimes even when Tesla is not the most actively traded stock on any given day, the Tesla options would be the most traded options on any given day. That's a unique thing with Tesla is that even the stock is not the most traded stock, the options could be, which there's your opportunity right there. You got a beta of 1.71. You got a really divisive crowd on this one. People, no one's lukewarm on Elon Musk. They kind of love him or hate him. They love or hate Tesla. People are throwing rocks at Teslas. And did anybody ever damage your Tesla?
Not yet. Thank goodness. Nobody's
Tennessee
done anything to mine.
Tennessee people are too nice, but in other places they'd throw a brick through it or something. So this is a very divisive stock, and that's what makes it volatile, and that's what makes it great to trade.
And did you see the big news this week, Jack?
I don't read news.
Don't new read news. Well, they got their rideshare permit from the state of Texas to operate statewide starting September 1st.
All right, now we gotta ask the participants. This just killed. Would you get into a robo taxi? It's a simple question. Type it in yes or no. I want to add it up. I wouldn't get in that thing if you paid me. Heck no, Jay House says. All right, no, yes, of course, Armand says. Waymo, yes. All right, see, I just wouldn't do it. How about Uber Eats? Would you let a guy bring you food? And he took a sip off your Coke and pinched some fries into there. I don't care what he says. So Uber Eats, would you let a guy deliver food to you, or would you get in a robo taxi? I wouldn't get. I'd take a horse before I got a robo taxi. Absolutely. See, this is the future, man. I'm just behind.
Yeah, I mean, Jack, we ever get together and I have one of my Teslas, I'll let you see how it drives itself.
How long? How long can it go before it runs out of electricity?
Well, right now, my truck can go about 300 miles.
That's pretty sweet. What's top speed?
I haven't tested it out. I think it's 160, 155,
I got a
160.
race. I got a almost 20-year-old truck that I drive that's pretty quick. I'd love to race a Tesla.
But I can do a 0 to 60 in less than 3 seconds. So
All right. Yeah. Well, people would take it. I think that's the consensus is that they would do it. And you could kind of tell the age of people too. Like I think older people wouldn't do it, but
I
yeah.
have two family members that don't drive, and I'm actually looking forward to the day when they can actually hail you know, a ride without having to have another driver in the car.
Yeah.
It will
I
provide
can't wait
freedom to
for
them.
my wife to get that. She's such a bad driver. I can't wait for her to get into one that's Stats show it's safer than human operated vehicles, Bob says. Well, there you go, right?
Yeah. So far, the self-driving 7 times safer than the average human driver. So
Yeah. Horse is
that's
more fun, Lori says. That is true.
it's all like, are there things to work out? Sure. Is it getting better? Is it the worst it's ever going to be right now? Yeah, kind of like AI. So every day it's going to get better, and it's one of
Yeah.
those things. Like, make your decision. If it was the choice today, maybe. Give it 6 more months, a year. Like, it's just going to get better and better. So
I'm too nervous the thing is going to turn left into oncoming traffic. I just wouldn't trust it. Not if I had a brake in the back seat, maybe. And but I might as well just be driving if that's the
Hey,
case.
Jack, I've had my truck for about 11 months, or no, 13 months. 13 months. Guess how many software updates they've put in that truck since I've had it?
3.
20.
Wow. What does that do when they update the software? Why
Adds
would
new
that?
adds new self-driving capability, adds new features, as they update it constantly. Almost once every 3 weeks, basically, since I've owned it.
Yeah. Now, having owned it, would you would you buy it again going back? Do you think that was a smart thing to do to buy it? Because sometimes you buy a truck or a motorcycle or something, and then you look back and think, I wouldn't have bought this if I had to do it all over again. Would you still have bought it if you had to do it all over again?
I love this truck.
Cool. Well, my
I
almost 20-year-old truck. So yeah, I know you can really love one.
I wanted a Corvette pretty much my whole life, and I wanted one of the older Batmobile type, the Stingray model, and for a long time I've thought about buying an old one and fixing it up, whatever. But this truck came along. I've kind of grown partial to drive. I drove an Avalanche for 21 years, and I kind of like that truck, but keeps all your stuff inside. And the Cybertruck came along and had the tonneau built into it, the vault. It's a lot like a Avalanche, but has the performance of better than a Corvette. So for me, it's kind of like the dream all pulled together. Has the performance of a sports car, yet the utility of a truck.
Now, the only thing I hate about those EVs is the sound of them. Is there any way to make it sound like a good old V8 internal combustion engine?
Mine is like dead quiet. I don't hear much at all. Like, it just
Like it
it
dead
just puts you back in
quiet.
the seat and lets you go.
I got the Magnaflow exhaust on this truck. It really, you can hear it. It sounds awesome. But hey, that's me. Let's get back to how to make money off this crazy stock.
Yeah. So, already it's polarizing, right? We've polarized the audience, and that's partly what makes Tesla so juicy to trade, right? That's kind of the point that Jack and I were just bringing to you. It's polarizing. Everybody has opinions, and that brings premiums.
That's what
So,
it's all.
Jack, what kind of trade do you love on Tesla?
Well, oddly enough, I like the debit spread.
All right. And I think we're going to go more over what actual debit spreads are on Friday. We've talked a lot about credit today, and I
Okay.
think we're going to cover debit spreads more in depth. But, for the high level, what is a debit spread?
High level for the debit spread is if you buy an option, a call on Tesla, it could cost you $1,300 to buy one call. Now, that's a lot to put into a trade, but if you buy that call for 1,300 and you sell the next higher strike price call, then you could get into the trade for $200 instead of $1,300, right?
Yeah, like right now, going out to September 12th, a 355, excuse me, costs almost $13.
Yeah.
1255,
Well,
1255 bucks.
yeah. Now, if you go ahead and sell that 360, you're into the thing for less than 200 instead of 1200, right?
Right.
So you
So
buy the 355
you
strike
buy
price
this one.
call, 1255, and you would simultaneously sell the 360 at 1090 and put a limit on the debit that you were willing to pay. All right, be like $165 instead of $1,265.
And right
And
now it's going for 11 on the
yeah,
360. So we're looking at
make
about
100% or more. I mean, you're capped at a little bit, but so what? If you're capped at like a 300% gain, that's now the other thing is though with this is that you just can't randomly go in there and pop that trade off. We need to get a special green light on the way Tesla trades. So that's the thing is Tesla can go up, down, or sideways. And if you put this on for like 10 days, be about the max, you can get amazing, amazing results with this. But only on Tesla. I haven't seen it work on this too as well on any other stock. Tesla's been the magic stock for that type of trade.